Hi guys, and welcome to Cultonomics. My name is Paul Hanley, and today I'm going to be chatting to you about
Keynesian versus classical views of the economy. In this video, I'm going to present an overview of macroeconomic historical events for the past 100 years and introduce the concepts of classical and Keynesian economics. So classical economics is most synonymous with Adam Smith, who lived during the 18th century, and his ideas would be based around laissez-faire, or a lack of government intervention, that people being rational and selfish would actually, going about their own business, be to the benefit of the entire society. On the Keynesian side is John Maynard Keynes, who lived during the late 19th, early 20th century, and his idea would be for more interventionist stance from especially the government and management of a macroeconomy rather than leaving it unregulated. So, in order to see where these link into historical events, we're going to start in 1929-1939 under the Great Depression era. And over in the States, this was synonymous with the Dust Bowl of the 1930s, where over-aggressive farming methods led to a loss of stocks and crops and led to great dust storms during this time that engulfed an awful lot of America. But economically speaking, it was synonymous also with the Wall Street crash of 1929, in particular October 29th on Black Tuesday, where stock market values plummeted. You had a stock market crash, the bursting of a bubble in terms of asset prices. You had massive unemployment in the States that went up to 25%. Trade dropped by 50%. Global GDP dropped by 15%. A massive recession. And you had policymakers who were going around as if sleepwalking and not being able to deal with this crisis in terms of the current economic thinking, which was classical economics, which was a lack of government intervention in that economy. We then move on to the post-war era, 1950 to 1970. So what we see in this era is a rebound based on, for example, policies such as the New Deal in the States, where Roosevelt invested in large public work schemes between 1933 and 1936. So this large fiscal expenditure was driven by the idea of Keynesian economics. So Keynes would have dominated this era, and because of this capital investment, you also had an increase in productivity, and you generally had large-scale GDP growth, sometimes referred to as a golden era in macroeconomic history. However, this came to an end during the late 1960s and 1970s. So what we had here was the collapse of the Bretton Woods system and oil price hikes. So the Bretton Woods was where currencies were tied to gold. So this collapsed in 1971 when the US terminated its convertibility of the dollar to the gold. But at the same time, you had OPEC, the Organization of Petroleum Exporting Countries, who were collaborating and doing a deal so as to reduce the supply of oil globally, so as to increase the price of that. So initially you had this oil price increasing the price of gas, petrol, diesel, etc. So at the petrol pump, consumers would have felt that. But you also had it in terms of firms, so a lot of the input costs were based on oil as an energy source and so on. So costs would have went up in the economy, and what happened was this led to prices going up, and it led to the economy stagnating and the wheels coming off the global economy, really, given the nature of oil being a global resource. We then move on to how the economy overcame this, and from 1981 to 2007 we had an era of Thatcherism, Reaganism, the Great Modernization, where classical economics and monetary policy came into vogue. And during this time we had a lot of deregulation, especially in the finance sector, which was dominated beforehand by the Glass-Steagall Act, which was a separation of commercial and investment banking. But in the 1980s, we had repeals of this. So we had a lot of banks involved in investment banking. We had privatization and liberalization of markets. So the shackles were taken off. No regulation or very little of it, so you had free market enterprise. And this was particularly the case in the United States, which had a era of economic growth due to deregulation, privatization, and finance markets increasing in price, stock markets increasing in price. All of this was fueled in real terms by debt and people taking out loans and using credit cards, etc., to fuel consumption and for firms to fuel investment as well. So we had a debt-driven economy at that stage, and eventually most debt-driven economies, they burst. And the bubble bursted in a big way in the global economy at the start of 2007, going up to 2008 and beyond that, with the financial crisis and the collapse of stock market and the halting of interbank loans across many big banks and the failure of big companies such as Lehman Brothers. Now, this wasn't just a localized financial crisis in the US. Because of globalization in the 1980s, this spread out and countries are linked together through supply chains and finance, etc. So this became a global financial crisis and moved into Europe as a debt crisis as well. And again, policymakers were somewhat sleepwalking and caught unawares by the scale of a financial crisis of this nature, its global scale. So initially, attempts to battle and to counteract this were quite muted, based on the going philosophy of the time of the Great Modernization consensus. So this meant that policymakers were quite smug at the time, and they believed that they cracked economic policy based on monetary policy playing the main stabilization role, central banks being independent and used to avoid the business cycle, and discretionary fiscal policy being used very sparingly. So in this case, monetary policy was the key area to concentrate on to stabilize an economy. However, with the financial crisis of 2007 to 2009, this monetary policy and the modernization consensus was not working, so the economy was not stabilizing. Well, it's based mainly on where the financial crisis came from, which is based again on banking system, finance, playing with risk and gambling money away. You had a change in the banking system away from the originate and hold deposits to originate and distribute money. So you had securitization of loans into big tranches where they were securitized together, bundles of loans in asset-backed securities, mortgage-backed securities, collateralized debt obligation, all these fancy terms, which was basically loans being put into bundles. And when these lost value, you started to have run on banks. So the central bank is a guarantor of the financial system, and when banks can't access money, they have to go to a central bank. So you started to have people who wanted to take out their deposits, and the government were the last really resort here to back up banks and to back up the central bank. So when governments linked their own budgets to central banks and to bail out banks, they increased their own debt levels. So you went from a financial crisis right up to a public debt crisis, in that case, as finance and government were linked. So you had an escalation of a financial crisis. There was an awful lot of measures to put out this fire, but it continued to escalate over the 2008-2009 period. The policies were too small in nature, too small of magnitude, and they weren't putting out this financial fire that we saw. So there needed to be a rethink of macroeconomic stabilization policy, heavier measures based around money, of course, but in two types. The first one was monetary policy, and we'll look at a few examples of how monetary policy tried to stabilize the economy. The second one we'll look at will be fiscal policy. So over in the States then, the central bank in the States, the Federal Reserve, they introduced a number of measures, large-scale measures, in fact, large-scale asset purchase program, and these were called quantitative easing. So you had QE1 in 08-09, purchase of nearly 1.75 trillion of longer term assets, including TARP of 700 billion. You had QE2 2010 to 11 of more purchases, 600 billion worth. You also had a reduction in the interest rate and the federal funds rate from 5.25 down to 0 and 0.25. The European Central Bank were a bit slower on the uptake in terms of changing their policy and scaling it up. They initially started out with securities market program in 2010, so of a smaller nature than the States, 214 billion by June 2012. They also also introduced 3-year long-term refinancing operations. So these were long-term loans for banks to keep them in operation, and almost €500 billion worth in euro of these. They reduced the reserve requirement, how much cash banks would have to keep, to 1%. Mario Draghi, the president, announced a whatever it takes policy in 2012. You had negative deposit rates for the first time in economic history, negative rates on deposits. And you had a whole range of measures. Now, this wasn't enough. So now we needed both monetary and fiscal. And America, again, were first to introduce the fiscal measures under the Bush administration in 2008, $152 billion. This wasn't enough. So under the Obama administration, we had the American Recovery and Reinvestment Act of 2009, $787 billion stimulus package there on rebates and taxes to business investment. You also have in China at this time, you have expansionary fiscal policy of 4 trillion yuan expenditure program in 2010, which is equivalent to almost $500 billion of US dollars that was spending on housing and rural infrastructure transport. You had expansionary policy in Germany as well, in Europe, of 50 billion. This looked at taxes, child tax credits, spending on transportation and education, etc. So now what we have is a look back on theory. So how did the theory drive the responses to these crises? Now we know already that we have the classical view emanating from Adam Smith, but we also have the Keynesian view, the opposing view of intervention from John Maynard Keynes. And we can see that these drove policy reactions to various economic crises over time. So with the classical view, we have a laissez-faire policy, which is non-government intervention. So governments should not intervene because the economy is automatically stabilizing. This is in contrast to the Keynesian view of government intervention, which looks at demand-side policies of managing the economy. Under the classical view, we assume rational self-interest, and this will lead to the benefit of everyone, this self-interest. Keynes took a different approach and looked at animal spirits, emotions and emotive concepts, and how this drove the economy. Under the classical view, we also had the assumption of free markets clear, that wages and prices are fully flexible. So in the long run, supply is driven by labour and capital, etc. Whereas Keynes's view was that prices and wages are sticky, that they're inflexible in the short run, and that markets may not clear for a number of years. In the classical view, we had the fact that the aggregate supply curve is vertical in the long run, that money and nominal variables don't have an impact on real variables such as GDP. So monetary policy shouldn't work, whereas in Keynes's view, the aggregate supply curve is upward sloping. And this means that when prices go up, yes, supply does go up as well, which denotes a role for fiscal policy. Classical view, the economy is self-stabilizing, it's automatic adjustment based on the real wage. Real wage will fall during a recession. And aggregate supply will increase. Whereas the Keynesian view is that because there's a short-term output gap, for example, during a recession, you need expansionary fiscal policy, a counter-cyclical policy in that case, to manage the economy, and the government steps in. The classical view would emphasize supply-side policies, not demand. And we can look at those in a minute in terms of what they would entail, whereas the Keynesian view would look at demand-side policies, so fiscal policy, government spending, reductions in taxation, depending on a fiscal multiplier effect. Government spending is multiplied up in the economy. So the classical view then, just to concentrate on it somewhat more, these supply-side measures, there are two different types of them. The first one is market orientated. So this is trying to make the market more flexible. And what they believe in is reform of tax and welfare, so maybe reduce unemployment benefits so people are incentivized to go back to work, flexible labour markets where wages can drop, reduction in government spending, and privatisation and deregulation. So liberalise the economy. Their interventionist policies then would be based around infrastructure investment for the supply side, investment in education and training to increase availability for jobs, R&D, and regional and industrial policies, maybe subsidies for companies as well setting up.
I hope you call back to Cultnomics soon. Bye for now.